Hello everyone. Thank you for joining us today for this month's Netwealth Portfolio Construction webinar, our series designed to help you see wealth differently. My name's Liam and I'm part of the marketing team here at Netwealth, and I'm delighted to be joined today by Jonathan Shead, who is the Australian Head of Retirement Solutions at State Street Global Advisors. Today, Jonathan will be exploring the world of global equities, including some of the benefits they can provide investors, as well as some of the key considerations. But before we get stuck in, I'll just run through some quick housekeeping items. As always, this webinar is being recorded, and you will receive a copy of this presentation, the slides, and a podcast recording within the next week after the conclusion of this webinar. Over the course of today's presentation, feel free to enter any questions in the question box on the taskbar to your right, and Jonathan will endeavour to answer as many as he can at the conclusion of his presentation. And if you like to be active in the social world, please use hashtag NetwealthInvest or @NetwealthInvest if you wish to share anything about today's presentation on your feeds. A reminder that all information presented in this webinar is general advice only and is not intended to be a substitute for financial advice. Now, to introduce today's speaker. As mentioned before, Jonathan is Head of Retirement Solutions in Australia for State Street Global Advisors. In this role, Jonathan is responsible for leading the development of retirement thinking and investing at State Street Global Advisors. He also, as well as considering the investment challenges peculiar in retirement portfolios, he is actively involved in retirement policy, product design, market research, and communication. So thank you for joining us today, Jonathan, and we will let you get stuck into your presentation.
Thank you very much, Liam, and good morning or good afternoon, one and all. Before I took on my current role as Retirement Solutions, I worked on the investment team for a while in both equities and currency. So this is a great opportunity to bring together investment ideas along with portfolio construction ideas for your clients. I'm going to be looking at 4 main items on this agenda. So looking at the benefits of investing globally, some of the things that we suggest you think about before committing your money offshore. And then I want to spend a little bit of time talking about currency, a few aspects of currency. But I want to kick off, if we're going to talk about investing globally, then what better place to start than Spain, and specifically Spain in the early 1600s. Miguel Cervantes, who wrote Don Quixote, those of you with a classical education might recognize this quote. "It is the part of a wise man to keep himself today for tomorrow and not venture all his eggs in one basket." And if there is one key benefit of investing outside Australia, it's diversifying, not having all your eggs in one basket. One of the best ways to spread your risks around in your portfolio, when you build a portfolio, we believe, is to include investments from outside Australia. And I'm going to talk about 3 key ways that we think investing outside Australia helps you to spread your risk. It also helps you to access different opportunities, but I'm going to focus initially on the risk side of the equation. So what are the 3 ways investing overseas helps you with your risk? Well, the first is that when you invest overseas, you gain exposures to other economies, and you gain exposure to other countries' economic cycles. And financial markets ultimately are driven by what's happening in the underlying economy. They'll often move in advance of that economy, but they are driven by what's happening in the underlying economy. This chart shows 3 countries, Australia, Japan, and the US, and it shows the economic growth on an annual basis from the 1960s through to the present time. And you'll see that those three lines do not line up. You get periods where some economies grow better than others, where Japan and the US has either underperformed Australia or outperformed. For example, in 2007 and 2008, we had a period where Japan and the US both experienced recessions. Australia managed to dodge that bullet. But next time round, if there is an economic recession in Australia, we're not forecasting anything in the near horizon, but if there is an economic recession in Australia, it's always good to have exposure to economies outside of Australia. So that's the first reason to diversify outside of Australia. The second reason is the nature of the industries or sectors, economic sectors, that are represented in the Australian financial world. And I focused on the share market here. This particular chart shows the Australian share market on the left-hand side and global share markets on the right-hand side. Each one of those circles represents a key investment sector or industry sector, and I've highlighted a few. The size of the circle represents the significance of that sector for the Australian share market on the left and global share markets on the right. So if you look in the Australian share market, there are two circles that stand out. The materials sector up the top left and the financials sector. So the financials being dominated by the big four banks, and then the materials dominated by BHP Billiton, Rio Tinto, South 32 and so on. In global markets, you can see that there's a much more even spread of opportunities. And in particular, there are industry sectors which you just can't get exposure to in Australia in any meaningful way. And I've highlighted three key sectors. The first at the bottom left is communication services. So in Australia, that would include Telstra, but not much else. Globally, and I'll give you some of the better known names, that would include AT&T and Verizon, but also Facebook, Google, Netflix, Disney, those kind of companies. Next in that list, we have consumer discretionary stocks. Now in Australia, that's dominated by casino and gaming companies. You think Aristocrat, Tabcorp, Crown and so on. You go globally, and it's companies like Amazon, Nike, McDonald's, Toyota, Sony, and so on. It's a completely different area of investment that we don't have significant exposure to. But perhaps the real standout is in information technology, or IT. In Australia, the only companies that you would recognise in that segment might be Computershare or Link, and globally you've obviously got companies like Apple and Microsoft and Intel, and so the list goes on. Now, I should hasten to add that we don't necessarily own those companies that I've named. I've just named them because they're indicative of the kinds of industries and the kinds of segments that you just can't get exposure to when you're only investing in the Australian share market. So that's the second area of diversification. The third area of diversification is really drilling down a little bit further into the nature of the companies, or the size or significance of the companies that you can purchase. And I've shown here on the left-hand side the 10 largest companies in the Australian share market and the 10 largest companies on the right-hand side in global share markets. But what I've done is I have kept the scale the same. So the Commonwealth Bank there, in US dollar terms, you can see is an $89 billion company. BHP Billiton is a $79.9 billion company, and so on. If you look across at the names on the global list, we're talking about companies that are 10 times the size. You have trillion-dollar companies like Apple, and depending on the price of the day, Microsoft and Amazon and so on. And in fact, if you were to list global companies that you can buy on the share market by order of size, CBA, Commonwealth Bank, and BHP Billiton would be the only two companies to make the top 100. They're the only two Australian companies that fall into the list of the 100 largest companies around the globe. So your opportunity to build well-diversified, risk-controlled portfolios without having to buy really very small or lesser-known companies is much wider in global share markets than it is in Australian share markets. One of the problems with investing in Australian share markets is it's much harder to hold a diversified basket of names just because there are fewer names available or fewer names of substance. So if you look at those top 10 names in Australia, they account for 44% of the market. The top 10 names globally, even though they are 10 times the size each of the equivalent Australian companies, those top 10 names only make up 13% of the total market. We don't necessarily use these kind of market weights when we build portfolios, but I think the point about the opportunity to invest in a much wider range of individual companies is a good reason to consider investing offshore. So if you're going to invest offshore, what sort of considerations should you have? The first most important consideration is what kind of markets you're going to invest in. Index providers, research houses like Standard & Poor's or MSCI or FTSE classify companies or countries into one of two categories. They're either developed or they're called emerging. There is actually a third classification called frontier, but most investment products you will see will focus on either developed or emerging markets. The considerations in classifying a country, it's a little bit arbitrary. They look at things like how wealthy is that country, how good are the market rules, how open is that country to foreign investment, how stable is its political environment, and so on. And while the rules are somewhat arbitrary, there's very little difference in the lists of what constitutes emerging or what constitutes developed. Emerging markets probably have better long-term growth prospects, but they also tend to be quite a bit higher risk. You tend to see bigger drawdowns when they sell off and more volatile share prices in those markets. In our global equity product, we chose to invest only in developed markets. We concentrate very much on risk as well as looking at return. We think those two things are equally important, and so we decided to limit our available investment universe to developed markets. So that's the first key consideration. The second consideration is you can diversify by investing overseas, but these are still equity markets. So prices still rise and fall, sometimes quite dramatically in short periods of time. So there's been a sell-off in global equity markets over this month, a bit of a rebound last night, but there's been a sell-off, and that sell-off has occurred around the globe. It's occurred in the US, it's occurred in Europe, and it's occurred in Australia. So global equity markets still have an element of risk. Risk also, however, means that there are opportunities globally as well. Risk or large price movements introduces opportunities as well as risk, and I want to talk about that in some slides to come. The third thing to think about is currency. Exchange rates, changes in exchange rates impact your returns when you invest overseas. And that's not just changes in the US dollar exchange rate, that's changes in exchange rates like the British pound or the Japanese yen or the euro. And we'll touch on that a bit more in a few more slides. But first I want to think about the risks and opportunities from global equity investing. On this slide, I've shown the average performance over the last financial year, over the 12 months to 30 June 2018, of 5 key markets: the US, Europe, the UK, Japan, and Canada. The box in the middle represents the average return over that 12-month period. And you can see there's quite a bit of variation. Europe had a relatively weak year with 4% return. The US had a very strong year with an average of a 14.5% return, and so on. It's the arrows on either side that I want to focus on, however. And those arrows represent the range of individual company returns making up that average of 14.5. So in the US, while the average return might have been 14.5%, there were companies with returns of losses of 20% or more, and there were companies with positive returns of 60% or more. A really, really wide range of results inside that 14.5% average. And you can see a similar wide range of returns in Europe, the UK, Japan, and Canada. And it's that range of opportunities that creates the ability for active managers to both pursue higher returns by identifying better performing companies, and also to manage risk by avoiding companies that are more vulnerable to those large negative returns. And that's key to how State Street manages portfolios. I'll just touch briefly on that in a little bit more detail. When we look to build both global equity portfolios and Australian equity portfolios, we place equal weight on maximizing returns and also minimizing risk. We think both of those elements are equally important. That means that in practice, we tend to ignore benchmark weights. So the fact that CBA or BHP might be the largest companies in Australia, or Apple or JP Morgan might be the largest companies globally, we don't tend to take much notice of that when we build portfolios. Secondly, we only hold companies that rank very well on criteria like the quality of their assets, the price that we have to pay for them, they're not too expensive, they've got sustainable earnings, they're generating growth, and it's good internal growth, it's not just growth by acquisition, and the market is viewing that company in a favorable light. So we only hold the most favored stocks. But at the same time, we are very deliberate and explicit in how we manage risk. And we don't think of risk as how close we are to what the market has done. We think of risk in absolute terms. We're interested in protecting capital, in minimizing negative returns, and so on. So that's the opportunities and risks of equity investing. But I want to move to the third of those considerations, which is currency. Currency sometimes causes eyes to glaze over. It's one of those deceptively simple yet deceptively complex subjects. And I think the easiest way to think about it is when you travel on holidays. I think most people have a family pilgrimage to Disneyland at some point in their life. And if you rock up at LA and you've got a 3 to 4 hour layover before your next flight, you go to Starbucks to buy a coffee. There's no good pulling out an Australian $5 note. We all know that you have to change your Australian currency for US dollars in order to buy something from Starbucks. It's much the same for investing. Professional money managers like State Street, when we buy shares overseas, we have to convert Australian dollars into foreign currency first, and only then can we buy companies overseas. I've got an example here on this slide, but I'll preface this example by saying if you don't follow through all the details of this example, don't panic. You can work through it with a pencil and paper or an Excel spreadsheet later. And even if you don't want to do that, you don't need to understand this example to get the punchline at the end. So I'll run through this very quickly for those of you who are so inclined. I just picked a hypothetical example. Cisco, which is an American technology company. Let's say we wanted to buy it in our portfolio at the end of last year, and it was trading at $38 in the US. We want to buy 10,000 shares. That means we've got to give a broker in the US $383,000. Well, we go down to the bank. The bank says, well, the exchange rate is 78 cents, so you are going to need to give us $489,000 Australian dollars, and we will give you 383,000 US dollars, and you can go and make that trade. Fast forward to the 31st of August. The share price is now $47, and we decide we want to sell it. So we sell those 10,000 shares. We get $477,000, but those are US dollars and not much use to anybody in Australia. So we go down to the bank. The bank says, oh, the exchange rate is now 72 cents. We'll give you $660,000 in return for your US dollars. Now, there are three return numbers if you look at the color coding on this slide. First of all, what's the share price movement been? The share price movement has been 24.7%. It's a 25% return. But the exchange rate has moved by 8%, 7.5%. The easiest way to calculate the total return for an Australian investor is just to look at the money we had at the beginning, which was $489,000 Australian dollars, the money we had at the end, which was $660,000, and see what that increase is. Well, that increase was 34.9%. So I promised you didn't need to work through that example to understand the punchline. So here's, well, this is actually the first half of the punchline. If you want to carve a punchline with a pocket knife into the top of your desk, don't do it yet. This is only the first half. But your total return on a global investment actually comes from three parts. There's the movement in the share price. There's the dividends, which don't normally make up a big part of the return over shorter periods. And then there's the movement in exchange rates. Now, those movements in exchange rates can be good or bad. In fact, movements in exchange rates can turn an investment that would otherwise have made a loss into a profitable one, or an investment that would otherwise have made a profit into a loss-making investment. And I've got three examples here where I've cherry-picked some periods of time to demonstrate that. So if you look in the period from 2009 to 2013, the total return, so this is including dividends and it's not annualized, global share markets increased on average by 120%. But the impact of foreign currency movements was minus 92%. So the end return for Australian investors was a 30% total return, 31.2% total return. And there are two other examples I've given there. You can see that currency movements, it can be quite surprising how over a number of months, progressive movements in exchange rates can have a significant impact on the return of an overseas investment. A very quick rule of thumb. Nationally, you know, we love cheering when Australians do well in the pool at the Olympics. There's a great sense of national pride. My rule of thumb is it works the other way around for offshore investing. So if you pick up the Fin Review or you watch the news and the Australian dollar has gone up, that's bad. No national chest beating at that point. That's bad for your overseas investments. It means your foreign currencies have detracted from your returns. If, on the other hand, the Australian dollar weakens, that means, by definition, foreign currencies have increased in value and foreign currencies have added to your returns. Which brings me to currency hedging. And this is usually where the eyes start to glaze over if they haven't already. Hedge is a very scary word. Most people are familiar with the noun, like a fence or a bush that you do or don't trim. But it also is used as a verb. And as a verb, it means to dodge or to evade something or to provide protection, kind of like a near miss, a dodge or an evade. And a currency hedge is where you dodge or you evade the impact of currency movements on your overseas investments. It's a bit like providing protection for your portfolio against currency movements. If you've got your penknife out and you want to carve into the top of your desk, this is what your total return on a global equity portfolio looks like. You have share price movements, which we've talked about, dividends, movements in exchange rate, and then the return of any currency hedge. And a currency hedge offsets the movement in exchange rates. And that is what makes up the total return of a global equity portfolio. Now, that currency hedge, you can dial it up or dial it down. So if you see a product that says it is 50% hedged, it means they've removed half of the impact of exchange rate movements and left half of the impact of exchange rate movements in. A portfolio that has a 100% currency hedge has removed all of the impact of foreign currency on your portfolio. Which brings us to the two main kinds of currency hedges. Those are passive hedges, where you pick how much of the foreign currency you want to remove, and it then just gets locked in. Now, I mentioned that currency movements can be either good or bad. And when you have a passive hedge, it removes good currency movements as well as bad currency movements. You kind of have to pick a level and then stick with it. Active currency hedging is where the manager tries to protect your portfolio against negative movements or bad movements in currency, while still allowing the portfolio to profit from positive movements in foreign currencies. Now, that sounds very difficult to do, and candidly, it is. It's especially difficult to do if you're trying to do it over the next 5 or 6 days, or the next month, or even the next year. It's surprisingly difficult to do. However, we believe that if you're willing to take a really long-term view, it's not an insurmountable problem. And there are some quite sensible things that you can do to manage long-term currency exposures to help you benefit from good movements but protect you from poor movements. And in order to explain that, I'm going to divert slightly back into equities. This chart shows a number of key equity markets around the globe, S&P 500 being the US, Europe, Japan being the Nikkei, Australia, and so on. One of the key measures that investors use when they look at share market investments is whether they're cheap or expensive. Am I paying too much for this company? And one of the many measures that investors use is the value of that company's assets. So if a company has $20 billion worth of assets and you're only paying $5 billion in the share market to buy the whole company, that's probably a bargain. If, on the other hand, the company has $40 billion worth of assets and you've got to pay $400 billion, then it better be doing something pretty exciting with those assets, because that sounds expensive. That ratio, the ratio of the value of a company's assets to its share market valuation, is what we've shown on this chart. So if you look in the US, that ratio is normally about somewhere between 1.5 and 3.5 over the last 15 years. And at the moment, it's towards the top of that range. So you're paying over 3 times the assets on average in the share market to buy a company. That's why a number of commentators are calling the US market expensive at the moment. So if a company or on average, a share market can be expensive or cheap, and that's actually quite a good, very long-term predictor of performance, can you take that principle and apply it to currencies? And we believe that you can. So I've shown here the exchange rate between the Australian dollar and the US dollar over the last 20 or so years. You can see back at the time of the tech wreck in 2000, the exchange rate actually got below 50 cents. It then rose, and at the peak of the last commodity cycle, got up to $1.10. Now, we would say that the Australian dollar looked cheap in 2000, which means that the US dollar, by definition, looked expensive. This is expressing the difference, the exchange rate between the Australian dollar and the US dollar. So December 2000, the Australian dollar looked cheap, the US dollar looked expensive. If it was expensive, you probably didn't want to own it, which means you wanted to hedge it. Fast forward to 2012, and the Australian dollar looked expensive and the US dollar looked cheap, which means in your global investments, you probably wanted to keep your US dollar exposure because it looked cheap. So this idea of a currency being cheap or expensive, we think is a good basis for deciding how much you want to hedge of your portfolio. However, we don't do it by just looking at squiggly lines on charts and deciding what looks cheap and expensive. There are actually economic models you can use to calculate theoretical fair value for a currency. They involve things like inflation. If prices are going up rapidly in a country, normally that means its exchange rate is weakening. The easiest way to think about that is what a hamburger costs. In fact, The Economist even publishes an index each year looking at currency valuations based on a Big Mac, quite famous in investment markets. But we do something a little bit more sophisticated than a Big Mac, but the idea of inflation being a key determinant of fair values is important. Things like terms of trade, which is what the price you're receiving for your exports compared to imports, and productivity and so on. So you can actually build an economic model that tells you whether a currency looks cheap or expensive compared to another currency on a very long-term basis. A couple of other considerations, and I'll focus on the bottom two here. The first is that every currency is different. So the US dollar might look reasonably valued compared to the Australian dollar, but that may not be true of the Japanese yen, or it may not be true of the British pound or the Swiss franc. So when you look at what currency exposure you want to keep and what you want to hedge, it makes sense to do different things for different currencies. The second thing is that you want to avoid large transaction costs. In some cases, clients will adjust their currency exposure by switching between unhedged managed funds and hedged managed funds. But that can be quite expensive because you have to pay the transaction costs, the buy-sell spreads. So we chose to include currency hedging inside the fund so that it is done for our clients inside the fund, tailored to each currency. And so here you can see some of the currency hedging that we've been doing on major currencies over the last 2 to 3 years. So the US dollar has been cheap. It's got closer to fair value more recently. And so we had a fairly low level of hedge. It increased towards a 50% level. It's still just a little bit below 50%. On the other hand, if you look at the British pound or the Japanese yen, they actually look quite cheap on these long-term economic models. And so we want to keep our UK pound exposure and the Japanese yen exposure because it looks good value on a long-term basis. The euro also looks good value, not quite as good value as the British pound or the Japanese yen. So we'll keep a fair bit of that. The Swiss franc, on the other hand, looks very expensive. And so I couldn't tell you what it's going to do in the next week or the next month, or even the next year, but over the next 3 to 5 years, we think the odds of the Swiss franc falling are much higher than the odds of them rising. And so we hedge that exposure. And so you get an average currency hedge on the bottom right-hand side, which was about 30%, which means we've kept about 70% of the currency exposure and we've removed about 30% of the currency exposure. That kind of process has been very successful for us, along with this focus on risk and return in how we choose companies in the performance that the global fund has delivered. This chart shows the total return on the vertical axis and the standard deviation of monthly returns, or the variability of those returns, on the horizontal axis. You want to be up in the top left, so you want to get the highest possible returns while keeping your risk constrained. And we've been very successful in doing that since January 2014, when the fund was released. And I'll provide just a brief snapshot of the State Street Global Equity Fund here. These figures are as of the 31st of July. There are updated fact sheets just been published in the last day or two and available from our website through to September 2010. But you can see there critical statistics like participating in as much of the upside as possible. 87% of upside, you want to be part of that, but you don't want to participate in the downside, only participating in 61% of the downside. And that's the kind of characteristic that we're looking for when we build portfolios. And I'll leave with a final note with retirement portfolio building. One of the reasons we've developed these kinds of products that focus on risk as well as return is because we believe that that is a crucial feature of portfolios for retirees. The need to have an eye on risk as well as return, we think, is critical for retirement portfolios. And so on that note, I might pause there, Liam, and we can perhaps see if there are any questions.
Yes, thank you, Jonathan, for your detailed insight there to the world of global equities and foreign currency. And listeners, we hope you found this presentation valuable. The State Street Global Equities Fund that Jonathan mentioned, a reminder to you guys, is available through the Netwealth platform. You can find it on the Compare Funds and Models page or the Buy Managed Funds. A reminder to you all that we will be taking questions now, and there's still an opportunity to ask Jonathan if you have anything on your mind. Just go to the question panel on the right-hand side of your taskbar and ask away. So, Jonathan, we might just get stuck into one here from Srinivas, who has asked for your thoughts on global infrastructure, if you have any suggestions in terms of sectors or countries.
Global infrastructure. We don't have a specific view on global infrastructure. I think infrastructure behaves a little bit like very long-dated fixed income assets, a little bit of long-dated fixed income assets, and a little bit of equity. So equity infrastructure, we don't really have a view on. I would say global real estate, which would be similar to infrastructure, we're probably slightly negative on at the moment if you're going to take a short-term tactical view, just because of the risk of rising interest rates. And I think the risk of rising interest rates would similarly impact infrastructure investments. However, if you were going to have infrastructure as part of a long-term portfolio, then I think you would want to make sure you include a global component.
Thanks for that, Jonathan, and hopefully that answers your question, Srinivas. And we've got another question here, and going back to currency now, is there any sort of countries that have really experienced volatile currency-wise, or anything that you're really keeping, any countries that you're, or currencies that you're really keeping a close eye on?
Sure. So countries and currencies that have really experienced the most pain in this year, in 2018, are actually emerging market currencies. So the last really sharp, sudden movement we saw in a developed market currency was probably the British pound after Brexit. But countries like Turkey and Argentina have had catastrophic currency movements. Those are emerging markets, and those currency movements are indicative of some of the risks of emerging markets. What's happened in Australia is we've had a progressive weakening of the Australian dollar over most of this year. So what that's meant is, if you look at what's happened in global share markets over 2018, the US has done pretty well. The rest of the world has done not nearly as well. In fact, many other markets are in negative territory. However, because the Australian dollar has been weakening, remember my national pride bit, when the Australian dollar weakens, that's good for your overseas investments. Because the Australian dollar has been weakening, the return in global markets has actually looked much better for Australian investors than many others. I think beyond that, inside developed market currencies, on a very long-term view, we still think the yen looks very cheap. It's probably the cheapest of all the major currencies, and the Swiss franc would look the most expensive. We're not forecasting any dramatic moves in developed market currencies in the short term, though.
And you mentioned there that the Australian dollar has weakened. Is there any reasons behind that, and do you think there's a chance it will turn around soon, or what are your future predictions?
We think that we're not expecting any dramatic movements in the Australian dollar against the US dollar in the near term. In fact, we think that at current levels, the Australian dollar is quite close to economic fair value against the US dollar. One of the tensions or risks in global markets at the moment is the fact that interest rate policies are diverging, and interest rate policies are an important determinant of exchange rates. So countries like the US and Canada and the UK are increasing their interest rates, whereas Europe and Japan are doing nothing. Now, if you wind the clock back a few years, everyone was reducing interest rates. We've now got some countries increasing interest rates, some countries flat and not doing anything on interest rates, and that does make short-term prediction of currency movements quite difficult. That's where we see things at the moment.
Okay. Thanks for that, Jonathan. I just had a question come here from Greg, who is wondering for what your thoughts on the volatility in Europe and for the euro and the British pound, given Brexit, and in the short term, given that there's a big EU summit on tonight.
Yes, one of the issues with the British pound and Brexit is it's one of those, for me personally, it feels like it's either going to be a hero's ending or a catastrophe. And those are, depending on how the Brexit negotiations work out, those are the worst kind of risks to try and forecast. I don't think we have any special insight into how Brexit is going to pan out and what that will mean for the British pound. I would say that if you look on a long-term basis, so if you take a 3 to 5 year view, geopolitical events tend to have less influence than you might otherwise think. So sometimes when you're in the middle of a geopolitical crisis, it feels like it's going to have a really big impact on valuations, and it may do in the short term, but over the very long term, it's usually underlying economic fundamentals like growth and inflation and terms of trade and productivity that tend to drive those long-term exchange rates. So, you know, the euro, we think on a long-term basis is probably going to appreciate. It's taken quite a bit of a hammering. The pound has taken quite a bit of hammering. I don't have any special insights into what either the pound or the euro are going to do over the next week or so, but we would think over the long term more likely to appreciate than depreciate.
Thanks, John.
When there's a question here about active management and global equity hedging funds and how they compare with fixed interest returns over the short term. I think, and this is one of the dangers of a word like hedge. So when you look at an investment fund, a hedge fund is quite different to a global equity fund that has hedging. So the State Street Fund is a global equity fund where we have selectively removed some of that impact of foreign currency exposure. But it is first and foremost a fund that just buys global equities. Hedge funds are a completely different beast. Hedge funds will do everything from taking views on interest rates to pork belly futures to long and short positions in emerging markets. Hedge funds do a little bit of everything, not just equity investing. So if I was going to compare the State Street Global Equity Fund that has some currency hedging with fixed income funds, I would suggest we would expect much better long-term returns, but a higher uncertainty or variability of those returns over shorter periods of time.
Thanks, Jonathan, and hopefully that answers your question, Fran. Now, we might end the webinar there. So thank you again so much, Jonathan, for coming in and sharing your insights. Listeners, we hope you enjoyed the session and found it valuable. A reminder that the recording and the slides will be distributed to you by email in the coming week. And if you'd like to find out more about State Street's Global Equities Fund, check out the Compare Funds and Models page on the Netwealth website. So thanks again, listeners, for joining us. We hope you can join us on our next month's webinar, and have a great day. Thanks.